Hey guys, hope you're having a great day. Your buddy Tim back with another video for you. And today we are talking ARMs. Not this kind of arm. We're talking about an ARM, a adjustable rate mortgage, which could cost you an arm maybe down the road. One of the questions I'm getting asked a lot now is about interest rates because, as you know, interest rates are going up. I think they're somewhere just north of 5% now, which is the highest they've been since 2018, I believe. And so as interest rates rise, fixed mortgage rates rise, people start looking at ARMs, adjustable rate mortgage. And the way it works with an ARM is you have a period of time where you know what your interest rate is. And then once that period of time expires, your interest rate could increase or decrease. It's not going to decrease every year or so until it hits a maximum amount. For example, there are what they call 3-to-1 ARMs, 5-to-1 ARMs, 7-to-1 ARMs, 10-to-1 ARMs. What that means is for an initial period of time, let's say on a 3-to-1 ARM, for the first 3 years, your interest rate is locked in. It cannot change, okay? If you're on a 3-1, if you're on a 5-1, it's locked in for 5 years. Then after that, it can go up annually by a certain amount. And there's the uncertainty. There's the thing that makes a lot of folks nervous about ARMs because you know what your interest rate is going in for the first few years, but you have no idea what it might be once you are past that first period. I think ARMs right now, adjustable rate mortgages, are somewhere just over 4%. And again, as I mentioned, conventional rates are a little over 5%. So you can save 1 percentage point if you do an ARM. But again, the unknown is what is your mortgage rate going to be at the end of the initial term. So let's look at that. Let's say you are getting a 3-1 today. And let's say the interest rate is the 4%. So for 3 years, you are going to pay the 4%. At the end of the 3-year term, the mortgage company takes a look at things like the index rate. And I think this is the amount of what they're charged to borrow money. And then they add on top of whatever that index rate is, they add an extra point or two, and that is called their margin. So let's say for the first 3 years, you're locked in at 4%. Well, once that ends, the mortgage company is going to look at whatever the index rate is. Let's say the index rate itself has gone up to 4%, and then they're going to add a percent on top of that. So your interest rate could go from 4% up to 5.5%. 6. Now, there are limits. They do put caps on them. They can't just go up arbitrarily. So let's look at the various caps that can protect you somewhat. The first cap is the initial adjustment cap. And that means this: if you've got a 3-1 for the first 3 years, you're going to be paying a set amount of interest. You know that. Well, then once the 3 years expires, you've got an initial adjustment cap that says it can only go up this much. Commonly, the cap is about 2%. So at least you know that. So what that means is at the first rate change, the new rate cannot be more than 2% if that is what your initial cap is, and this should be in your mortgage information. Then you have the subsequent adjustment cap, and this tells you what the cap rate is for subsequent periods. All right, so let's say you get through your 3-year period, you're at 4%. Let's say they tack on another 2% once you go through the first adjustment phase. So you're at 6% now. And remember, this is 3 years down the road. So even then, that may be a good rate, right? So the initial cap says it can go up this much the first year, and then the subsequent cap says it can only go up this much over subsequent years, okay? But it doesn't go on forever. There is a lifetime adjustment cap as well, and this is the maximum amount that it can go up subsequently. Typically, that's 5%. It varies depending on the lender, but it does tell you that, your final rate will never be above, let's say, 5% over where you are now. So 4 or 5 years from now, your ARM may have adjusted to where you're paying 6 or 7%. But again, it depends a lot on where the indexes are that the mortgage company is going to take the base rate. So that's the risk of the adjustable rate mortgage, is you are locked in for the initial term, be it 3, 5, 7, or 10 years. Then you can expect an increase, because rates are not going to go down, guys. You can expect an increase in year 4 and then subsequent years up to a particular cap. So, the nice thing is, with an ARM, you've got a few years of a lower rate, and then you just have to be ready. Now, one thing that you can do, ARMs are really good for more higher price properties. If you're in a lower price range, 250, you're just as well off to go with a conventional mortgage. All right, but let's say you're only going to be in this home for 2 or 3 years, and then you plan on selling. Well, locking in a 3-year ARM or a 5-year ARM is not a terrible idea, because the plan is for you to sell the home before the rate adjusts, okay? The only danger there is the best laid plans of mice and men usually go the way of the dinosaurs. So you do run the risk, if a few years from now you are unable to sell the home or to refinance the home, then you're going to be locked into that ARM rate. All right, hopefully that makes sense. So, so there you go. You may be considering an ARM just to save some money up front. What I encourage my clients to do is look at the overall dollar amount that you're going to pay back on a mortgage. All right, and just a minor fraction of a point can make a huge difference, but you can look at, okay, what's my final payback on a 5-year mortgage, or a 5% rate mortgage over a 30-year term, versus what is my payback going to be if I go with a 5-to-1 ARM over the length, okay? Because you're going to be locked in there for the first few years. Then over the subsequent years, it can go up again as much as typically 5%. So if you get a 4% rate now, you could end up ultimately paying 9%. But again, 4 or 5 years from now, when it does increase, that could be a good rate. We don't know. So, all right, guys, I hope that was helpful. Hey, if you like what we do here on the channel, click that subscribe button, click the little thumbs up, the bell notification icon. That way you never miss another video. And if you like what we do, we appreciate that. Also, don't forget, if you are looking at relocating to the area, we've got Revolved Realty here, 82 agents now on the ground, ready to go to work for you. And we will do everything we can to help you find a dream home. And if you need help connecting with a mortgage company, we can certainly help you there too. So there you go. It may be worth your while to check out the ARM, and then again, may not. Just make sure you understand the overall numbers, so at least you have an idea of what you are going to be paying down the road. All right, guys, that's it. I hope it was helpful. If I can do anything for you, do not hesitate to reach out. Let me know in the comments below. What do you think? Would you do an adjustable rate mortgage in this market? Is it something you're considering now? I'd love your feedback. So, all right, guys, that's it. Get out and make it a great day. We will talk to you soon.